In this video, we're diving into direct indexing, a powerful investment strategy that's transforming how wealthy investors approach tax-efficient portfolio management. Let's start with the fundamentals. Direct indexing is an investment approach where instead of purchasing an index fund or ETF, you're buying the individual stocks that make up that index in the same proportions. But it's much more than just deconstructing an ETF. It's about creating opportunities for tax efficiency that simply are not possible with traditional index investing. For example, when you buy the S&P 500 through an ETF like VOO, you're getting exposure to all 500 companies, but you're treating them as a single investment. With direct indexing, you own each component stock individually, which means you can manage each position separately for tax purposes. Here's how it works. Let's say you want to invest $1 million in a strategy that tracks the S&P 500. Instead of buying shares of an ETF, your portfolio would be constructed in three main components. Large cap core holdings. You'll directly purchase shares of the largest companies in the index, typically the top few hundred stocks by market cap. These might include Apple, Microsoft, Alphabet, Amazon, and many other major companies that drive most of the index's performance. Then, to maintain proper market exposure, you might add ETFs that track mid-cap stocks, small-cap stocks, and any remaining segments that are needed to match the index's performance. Your portfolio will then need regular rebalancing to maintain proper index weights, account for corporate actions like mergers or splits, and then take advantage of tax loss harvesting opportunities. This is where direct indexing becomes particularly powerful for high net worth investors. Let's break down the tax optimization process. Daily monitoring. Your portfolio is monitored for daily tax loss harvesting opportunities. Unlike traditional tax loss harvesting where you're waiting for an entire ETF to decline, direct indexing looks for losses in individual positions. When a stock in your portfolio declines below your purchase price, you can sell the losing position to capture the tax loss, immediately reinvest in a highly correlated stock to maintain market exposure, and then bank that tax loss while staying fully invested. These harvested losses can then be used to offset capital gains from other investments, reduce your ordinary income by up to $3,000 annually, and carry forward excess losses to future tax years. Now let's go through a detailed example of how this works in practice. Let's say you have a $2 million direct indexing portfolio tracking the S&P 500 during a volatile market period. The traditional ETF approach would be your S&P 500 ETF is up 2% overall, and there's no tax loss harvesting opportunities available. So therefore, you must wait for the entire ETF to decline to harvest any losses. On the other side, the direct indexing approach, your portfolio might also be up 2% overall. But in the technology sector, Meta is down 15%. In the healthcare sector, Pfizer is down 12%. In the financial sector, multiple banks are down 8 to 10%. And then various retailers are down 5 to 20% all across the board. In this scenario, you could harvest approximately $40,000 in losses, replace Meta with Alphabet to maintain tech exposure, replace Pfizer with Merck to maintain healthcare exposure, make similar substitutions in those other sectors, and then use those losses to offset gains from other investments. The end result is that you've maintained your desired market exposure while banking nearly $40K in tax losses, all while the overall market is up. Direct indexing is particularly valuable for high-income investors who have significant capital gains to offset that are in the highest tax brackets and regularly sell appreciated assets. It's also valuable for investors with complex tax situations, like business owners with irregular capital gains, executives with concentrated stock positions, and individuals managing multiple investment properties. Also for those with large portfolios. Direct indexing typically has a large minimum investment. To implement direct indexing, the key is choosing a solution that provides sophisticated tax loss harvesting algorithms, regular rebalancing, risk management, comprehensive reporting, and integration with your broader tax strategy. Direct indexing represents the next evolution in tax-efficient investing for high net worth individuals. While it requires more sophisticated portfolio management than traditional index investing, the potential tax benefits make it an increasingly attractive option for wealthy investors looking to optimize their portfolio's tax efficiency. For investors seeking to maximize their after-tax returns, head over to range.com for more information. Thanks for watching.